Good morning. As Art mentioned, my name is John Ide, and I am a managing director and partner at Star Mountain Capital, and we are a lower middle market direct lender focused on non-private equity sponsored, privately owned, founder-owned businesses. And the title of my discussion this morning is Finding Alpha in the Less Efficient U.S. Lower Middle Market Direct Lending. I should have put direct lending in there, but it had been a mouthful. So direct lending. And I'll just take a step back and say, generally, I think direct lending, whether you're focusing on the lower middle market, which I'll define in a minute, or you're focusing on kind of the core or large direct lending market, I think it's one of the best asset classes to be invested in as a investor. And I say that both from a risk return perspective, but also from a absolute return perspective. Because as a direct lender, most if not all of your exposure is at the top of the cap stack. You are the first lien senior secured lender to this company. From an absolute perspective, I actually spent a chunk of my career at JP Morgan, and they come out every year with a long-term capital market return perspective. And if you look at their 2022 expectations, direct lending in the major asset classes is probably one of the highest returning except for private equity and emerging markets equity. So think about it as you're getting a really good absolute return and you're highest in the capital stack. So it's just a great space. And so what I'm going to talk about is I'm going to bifurcate the spaces, and I'm going to talk about the lower middle market, and I'll define the lower middle market, which is companies that are between 30 and 150 million in value, will typically have revenues between, let's say, 30 and 200 million, and annual cash flows between 5 and 20 million. So that's how we kind of define the lower middle market. And then kind of everything above that is the core or large middle market. So those are companies that could be anywhere from 150 million in valuation up to 2 billion. They could have cash flows between 20 million into the hundreds of millions. And they can typically have revenues that are north of $1 billion, $2 billion. So pretty large companies, almost getting close to the S&P-like companies. So what's happened over the last decade is we have seen a kind of a perfect storm that has really driven the direct lending market. The first is yields. As we've all seen over the last 2 or 3 decades, the yields in government bonds, corporate bonds, high yield bonds have all come down dramatically. Think of like 6-7% down to, well, until the recent couple of months, to the 2%, and 10-year treasuries were at 50 basis points not that long ago. So we've seen yields come down, and investors such as yourself are looking for yield. And where do you turn to? Many of you have turned to the direct lending space. The other part of that is commercial banks. Commercial banks used to be very active in the direct lending, cash flow-based lending business. But 2 things have happened. One is the number of banks out there today is pretty much halved in the last 25 years, so there's less banks. The second part of that is the banks, because of Dodd-Frank after the financial crisis, the regulatory capital for them to hold against these middle market loans has gone up significantly. So that's caused banks to pull back from this space. And the positive side of that is investors have stepped up with private capital, and direct lenders such as ourselves have stepped in to help fill that void. And as you can see here, the private debt direct lending space has actually tripled in the last 10 years, from roughly 60 billion to over 190 billion, and that is still growing. And a lot of the growth in the private lending, direct lending space is really driven by the private equity business, because a lot of the portfolio companies of private equity lenders, they're the ones that are looking for these first lien senior secured loans for their portfolio companies. And that is why you've seen this dramatic growth in direct lending, and it's the same with private equity. If you looked at last year, middle market private equity deployed over $600 billion across 4,100 deals. That's a record, and it's 50% higher than the previous record, which was back in 2019. So there is a lot of action going on in the private equity business, which is bringing along the private debt business. The thing about the lower middle market versus the core middle market, and the core middle market, as I mentioned, is very private equity driven, and the lower middle market, for the most part, those businesses are privately owned, they're founder owned, and they're not owned by a private equity sponsor. And with that, they tend to have less sophistication as opposed to a private equity sponsor-backed company. And so they're really good at running their businesses, but they're not great on the financial side. So finding a lender that can help them, create a structure that works for them is very valuable. Whereas in the private equity space, and that's typically where the core direct lending market finances, in the private equity space, most private equity sponsors, in addition to having their investment team that are looking for good investments in companies, they actually have a capital markets person or capital markets team that all they do is to go out and try to find the cheapest and most flexible capital. And what that has led to is leverage in that space has gone up significantly. In fact, as you can see here on the second to last bullet, leverage is now at 6.4 times cash flow of a company. That is highest it's been since 2005. In addition to that, the financial covenants that these private equity sponsors can negotiate with their portfolio companies and these direct lenders in the core space are pretty much covenant light. About 80% of the deals out there today are covenant light. And what I mean by covenant light is that means that there are no financial covenants or maybe one financial covenant in the loan agreement. And that's not good for direct lenders. Whereas in the lower middle market, we still get a full set of financial covenants that are tested quarterly, and I'll talk about that in a minute. The last thing that we've seen because of this competitive nature in the core middle market is we've seen spreads get squeezed. And just since the pandemic, back in early 2020, we've seen spreads tighten by 125 basis points, whereas in the lower middle market, spreads have been actually pretty stable. Why would you want to be in the lower middle market? Well, there's a multitude of different reasons. First and foremost, it's actually a really large market. People think about lower middle market, oh, these are these tiny companies, they're the local dry cleaner, they're the pizza owner. No, these are real substantial companies that have values, as I mentioned, between 30 and 150 million. They could have revenues upwards of 200 million. No, these are substantive companies, and there's over 200,000 of them. And so there's a lot of good companies to lend to in that space, and they represent a third of the private sector GDP here in the US, and they employ almost 50 million employees. So this is a big pond to fish in. The second thing is that it's much less competitive than it is in the core middle market. And One of the reasons, as I mentioned, was because of the banks not coming down into this space. The other reason is the larger direct lenders, those who have raised multi-billion-dollar funds, they just can't focus on the lower middle market because, one, it's very labor intensive. There's not the same level of sophistication in systems in the lower middle market as there is in the core or larger end of the middle market. And secondly is that after you've done all of your labor intensive due diligence on this company, the typical loan size in the lower middle market is about 25 million. Whereas if you look at the core middle market, that number is 250 million plus. So that's why you don't have a lot of the large players coming down into the lower middle market. In fact, the lower middle market is many times, it actually has more managers, but they're SBIC funds. And I don't know how many people here are familiar with SBIC funds, but it's an organization that's underneath the Small Business Administration within the government, and they get a very attractive leverage that is guaranteed by the SBA. So a small SBIC manager will go out, raise maybe 100 million of equity, get 175 million of leverage, and they can go off and start making loans in the lower middle market. And like I said, there's about 300 of those. So that's really the competition in the lower middle market. As I mentioned before, lower middle market has a full set of financial covenants, which is very important if you want to catch a problem early. The other nice thing about the lower middle market versus the core middle market is the lower middle market has really nice diversification benefits for traditional asset classes, very low correlation to global bonds, US real estate, infrastructure, hedge funds, and it ranges anywhere from 0 to maybe 0.3. So it's a really attractive market. And then lastly, this market, because of the size of the market, is really underbanked, not by just commercial banks, but also by investment banks. And so lower middle market managers that can help these businesses institutionalize, professionalize, grow, because they have a team that has that experience, are really valuable in the lower middle market because they just don't get that type of advisory service from the investment banks. So let's talk about the favorable investment characteristics of the lower middle market. As I mentioned, 30 to 150 million roughly in valuation, over 200,000 businesses, generating 10 trillion in annual revenue, employing 50 million people, so big market to fish in, to find good businesses to lend to. You're not gonna have a problem there. The other thing that's kind of interesting that I think people don't realize is that lower middle market businesses are very consistent in terms of their revenue growth. In fact, as you can see on this slide at the bottom of this page, in the blue, the revenue growth is pretty consistent. Obviously, COVID hit both the S&P 500 companies as well as lower middle market companies. But if you look at it, that pretty flat line in terms of growth vis-a-vis the volatility in the S&P 500 companies, it shows they're actually very stable and profitable businesses to invest in. As I mentioned before, there is less competitors in this space. Again, banks don't want to come down in this space. For the most part, in the banking side, in the lower middle market, if banks do come down into the lower middle market, typically what they do is asset-based lending, and that's a very formulaic lending practice where they'll give you 80% on your accounts receivable, they'll give you 50% on your inventory, and maybe they'll give you 50 to 70% on your real estate owned, and do the math, and they come up with here's how much we can lend to you. But the lower middle market is very much more a cash flow based lending, just as we do at Star Mountain Capital. I mentioned before about what's going on in terms of competition with the large lenders. They just don't want to come down here. They can't deploy their multi-billion-dollar funds, making $25 million investments over a typical 3-year investment period for a direct lending fund. Banks, again, been cut in half over the last 25 years. Dodd-Frank has really put in them out of the cash flow-based lending business because of all the leverage, the big L word that banks are concerned about. So they kind of stick to the asset-based lending business in the lower middle market. But managers who are willing to come down into the lower middle market can make really nice yielding and lower risk loans than the core middle market. Let me take a step back. How many in the room, investors in the room, have exposure to direct lending, if you don't mind me asking? All right. Thought there would be more of you. I think I'm considering it's an asset class these days as opposed to an opportunistic investment. But the lower middle market companies do have really ideal investment characteristics because many of these companies, as I mentioned, these are privately owned businesses, family-owned businesses, management-owned businesses that have been around for 20 plus years and have survived, if not one, multiple recessions. So these are really stable businesses. There's great alignment, right? What better alignment can you have when the owner has the equity in the business and that is probably their lifetime retirement plan, that they're going to be very supportive of their lenders if there is a problem and step up and put more capital into the business. They typically have very strong competitive positions. Again, these are sizable companies, but they tend to be very regional. So what you'll find is a lot of these lower middle market businesses are one of the top 1, 2, or 3 businesses in their industry, in their region. So these are stable, long-standing businesses that have a great competitive position. As I mentioned, very stable and predictable cash flows, which is very important for cash flow-based lenders. And lastly, the typical range of employees in a lower middle market business, depending upon what they do, whether it's more software or digital media, digital advertising, or whether it's more manufacturing or industrial-like. The teams can be anywhere from 25 to 200 plus employees, so these are sizable businesses. And the nice thing about these founder-owned, family-owned, management-owned businesses is that many of the employees have been there for decades. They've been there from many times day one. So you've got a really great, experienced, talented management team. And really what it gets down to is these lower middle market companies are really just looking for a finance partner that can help them grow their business. Let's talk about the case for investing in a private credit fund, lower middle market private credit fund. I've alluded to a couple of these points already, but really the two big things are they're lower levered than the core middle market. As I mentioned, the core middle market is running 6 times plus debt to EBITDA, or debt to cash flow. A typical lower middle market company is running between 3 and 4 times debt to cash flow, or EBITDA. So a much lower, almost half the leverage. And that's really important, especially today, because there's a lot of uncertainty out in the marketplace. And I'm going to talk about a couple of reports that are done by Moody's and S&P that'll support this, is that this is the time to be de-levering, not increasing your leverage because of all the uncertainty going on in the markets. And what you're seeing in the core middle market is, as I mentioned before, leverage is trickling up right now, which is a little bit scary, whereas in the core middle market, or the lower middle market, with these lending to these smaller companies, it's been very stable. The other thing, as I mentioned, is this whole thing, and I'm sure many of you have heard the term covenant light, And right now, in the core middle market, there's about 80% of the loans out there are covenant light, which means, again, they don't have any covenants, financial covenants, and maybe they have one or two occurrence covenants, which are not tested on a quarterly basis. Whereas in the lower middle market, it's standard that you have at least 3 or 4 financial covenants, and that could be a leverage covenant. It's typically the first 2 are almost a non-starter. They have to be in there, which is a leverage covenant, which is cash flow to debt, and then the other one is an interest coverage charge. And then many of them will also have some minimum cash flow, as well as a max on any capital expenditures that the owner can make in any given year. That's important because those are tested quarterly, and they are calculated by the CFO of that business. And if there is a breach in one of those covenants, that is the same as missing a principal or an interest payment on their first lien senior secured loan. They're in default. And what those covenants allow you to do is they allow you to catch a problem early, and then you can work with the management team of that company to come up with a plan that you both agree to turn around the business, and then help them implement that plan. In a covenant light scenario, in the core middle market, which I mentioned is about 80% of the core middle market, actually more recently new loans that are getting done there are closer to 90, 95%. But overall, today the loans are outstanding about 80%. In that scenario, with no financial covenants that are tested quarterly, the only way that that borrower in the core middle market is in default on their first lien senior secured debt, top of the cap stack, the only way they're in default is that if they miss a principal or interest payment on that loan. And I would argue that if you are a company and you default on your senior debt in your capital structure, you have done everything possible to try to raise capital to make sure you make those payments, because when you miss those payments, that lender can come in and take the keys. And that's the last thing you want to have happen. There's 2 interesting research pieces that support kind of what I'm saying here today, both from a leverage perspective and then from a default perspective. So Moody's has been doing research over the last 25 years, and they actually have been doing this research report for a number of years, and they update it every, let's say, 12 to 18 months based on new loan data. But they've looked at over 20,000 loans across a number of direct lenders and financial institutions. And what they were looking for is to try to determine what are the top drivers of defaults in the middle market. And what they found was the number one contributor to defaults, the number one determinant of defaults in the middle market is leverage. It determines 26% of defaults. The least determinant of defaults in the middle market is the size of the company. So that just shows you the importance of keeping your leverage down no matter what size of company you're lending to. The second research piece, which is S&P, they've done work on defaults as well, and they've looked at tens of thousands of loans over a 23-year period, and they bucket the loans in sizes, less than 100 million, 100 to 250 million, and then 250 million and above. And no surprise here, with high leverage and limited covenants, the default rate on loans 250 million plus are 3 times the size of loans under 100 million. A couple of other points about favorable characteristics of the lower middle market. One is diversification, and this chart here on the right shows you the diversification across all the major asset classes, and it's pretty low. I mean, it's 0 to typically 0.3. I think the highest one is or private equity and public equity. But I will say that lending to lower middle market companies is not riskless. There are risks in lending to lower middle market companies. And those risks are, for example, operating histories. There's a lot of lower middle market companies out there that haven't been around for a long time, 5, 10 years, haven't been through a cycle. Those are the ones you want to avoid. You want to lend to those that have been around for 20, 30 plus years, that have been through a cycle, maybe two, because you know what to expect by looking back at how they performed in the previous cycles. The other thing, because these are smaller companies, lower middle market companies tend to have customer concentration. And the way you get around that is you just set limits on it. So for example, if you're a lower middle market lender, you might say, I don't want any single customer to be greater than 5% of my revenue, or that company's revenue. And then even broader, you could say, I don't want the top 10 customers to be maybe more than, a third to 35% of the revenues of that particular company. Again, many companies are younger, 5, 7 years old, and their talent and their management team is relatively young. The way to get around that is just look for, again, companies that have long operating histories, as well as having management teams that have been around with that company for tens of years, and the owner is giving them some sort of equity stake. So you have that alignment with the management team and the owner and the lenders, of course. And then lastly, defensible market position. And really, back to my point, which is I made earlier, you want these companies to be, one of the top 3 players in their industry, in the region or city that they're operating in. And that's the way you can get around the defensible market position. The last thing I'll mention, and this is pretty unique to lower middle market direct lending. As I mentioned, in the core space, you find that most of the loans are going to private equity sponsored companies. And those private equity firms are really just trying to get the cheapest and most flexible capital they can. And they're definitely not interested in giving up any equity they have in that company, because that's what they do. But in the lower middle market company, which just doesn't have access to other sources of capital or advice, investment banking advice, advisory advice, they are very open to finding lenders who, in addition to provide their balance sheet, can also help them, institutionalize and professionalize their business. And that could be as simple as helping them recruit maybe a COO, a CFO, a head of HR, to allow the owner or owners focus more on the strategic side of the business, growing the business, and also to help them grow, help them think about organic growth, help them think about making acquisitions. And so many lower middle market lenders, if they have the expertise in-house, have people that came from investment banking backgrounds, private equity backgrounds, private credit backgrounds, or even were C-suite operators of lower middle market companies or middle market companies, they can come in and help advise that owner, not just helping them with their capital structure, but also helping them on their growth plans. There are 2 really good tailwinds for both lower middle market business owners as well as lower middle market lenders. The first one is demographics. Most of the lower middle market companies, surprise, are owned by baby boomers. And those baby boomers, are in their mid to late 50s. And if they don't have a generational transfer, i.e. a child that wants to take over the business, and they want to retire, they've got to think about how they're going to exit. And what we're seeing here on this chart is that baby boomer generation is only growing. So the number of owners of these lower middle market companies, that age cohort is at about 16% today, and it's projected to go to over 20% by 2050. So there's a lot of those baby boomers that own these lower middle market businesses that are thinking about exiting, but they also want to maximize the value upon exit. The second tailwind here is the fact that there is a premium. There's a premium that is paid, and it's about a 25% premium between what lower middle market companies can sell their business at to, let's say, a strategic or a private equity firm versus what you can get in the core middle market. And we estimate that premium at about 25%. And to put that into numbers, the typical lower middle market company today could probably sell, with obviously good characteristics, could sell for somewhere between 6 and 8 times annual cash flow, which that's a great value. In the core middle market, strategics and private equity firms will pay 8 to 12 times trailing cash flows, annual cash flows. So if you are a lower middle market business owner thinking about, I'm going to sell my business in 5 years, you want to align yourself with a capital partner who can not only provide that capital to help you grow that business, but also help you do things such as think about organic growth where you can expand maybe in a different city, or more commonly, it's through acquisitions, helping you find, analyze, execute, and integrate on making acquisitions of competitors within your region. And so if you can find that partner that can help you take that business, let's say from 10 to 12 million in EBITDA or annual cash flow to, let's say, 25 to 30 million through acquisitions, you get to get that multiple premium of from 6 to 8 times up to 8 to 12 times. And so if you're a business owner and that proposition is on the table, you're very interested in bringing on that lender to help you get to that point. And for the lender, that usually equates to roughly about a 4% incremental return over just straight lower middle market direct lending, first lien senior secured lending. So there's some real value in that for both the business owner as well as for the lower middle market direct lender. Just to tie things up here as we're coming to an end, we think, number one, direct lending is a great business, whether you're in the core or lower middle market. We just think the lower middle market is better. And we think that because, one, it is less risky, lower leverage, full set of financial covenants. It offers higher yields. The typical yield on a core middle market loan is somewhere between SOFR plus 5 to 7%. Where in the lower middle market, that number is SOFR plus 8 to 10%, so about a 2 to 3% yield premium. And that's just based on company size, not reflective of risk, in my opinion. If you are a lower middle market lender that can then provide these value-added services in terms of helping them institutionalize, professionalize their business, or grow the business, more importantly, the equity upside for lower middle market lenders is anywhere from 4% plus on top of that SOFR plus 8 to 10% yield. And then lastly, which is kind of a bonus, is that the lower middle market direct lending space offers some really nice diversification across the most asset classes. And I'll stop there, see if anybody has any questions. Yes?
What's a good leverage level for a middle market in comparison to?
Yeah, so the question is, what is a good leverage level for a lower middle market company? And we would argue between 3 and 3.5%. Or, excuse me, 3 and 3.5 times. Yeah, 3 and 3.5 times. So, you know, if, put it into numbers, if you've got a company that's generating let's say 10 million in EBITDA, you could probably comfortably lend them, let's say 30 to 35 million in first lien senior secured loans. Yeah. The question is, what is the impact of the internet on the lower middle market? And do you mean, yeah, that's what I figured you were saying is the delivery market. Well, that's a good question. We tend to, as a direct lender, stay away from the retail space because of Amazon. So there's an easy solution there is just don't play in the retail space. And I probably wouldn't, because I think between that and what's going on in the metaverse world, I don't know if I want to play in the retail world, because I think our retail world's going to be turned upside down. So that's probably how I'd best answer that. Other questions? Great, thank you for your time. Oh, no, one more, sorry. Go ahead.
What do you see with the impact of rising rates on the middle market, and what concerns around extending or upcoming maturity?
Yeah, so the question is impact of rising rates and then how that might extend maturity dates. So the nice thing about the lower middle, well, just the middle market direct lending space is all of it is floating rate. So as we see, there's a lag because it's floating off of either a 3-month SOFR or a 3-month LIBOR, which pretty much tracks the Fed funds rate, but at a 3-month lag, if you will. So as short-term rates are going up, the yield or the interest coupon that you earn on that loan goes up with it. Then your question about rolls, that's more of a credit issue, in my opinion. So you certainly have to be worried about that. And we saw a lot of that in COVID, where you saw a lot of middle market businesses get impacted significantly, and where you had to perhaps roll. But that's more of a partnership decision when you're working with a business owner that you've known for 3 or 4 years, you know their business well, and they had been impacted by COVID, and you know that business is a very solid business. You'll work with them to help withstand that bump in the cycle, and hopefully they come back.